The broadcast is now starting. All attendees are in listen-only mode.
Hi, everyone. Welcome. We're now ready to begin our webinar, Employee Ownership for Business Succession. Next slide. I'm Virginia with Rutgers School of Management and Labor Relations, and I will be your host and moderator. The New Jersey-New York Center for Employee Ownership is the proud sponsor for today's webinar, and we have allotted 45 minutes for this presentation. We encourage everyone to send us questions throughout the presentation. To do so, you will click on the orange arrow, which opens and closes your controls. You will type your questions into the box and press send at any time. We will take questions throughout the presentation. This webinar is being recorded, and a link to the archived version will be sent to you via email by the end of this week. It's now my pleasure to introduce our presenter. Dr. Corey Rosen is the founder and senior staff member of the National Center for Employee Ownership. Dr. Rosen is generally regarded as a leading expert on employee ownership and has appeared on numerous national radio and television news programs. Corey, please take it away.
Thanks very much. Last time I was referred to as doctor, I think, was in graduate school. But in any event, I really appreciate all of your coming here. I do want to really encourage you to ask questions. If any of you have done webinars, you know it's a kind of weird experience. I'm literally talking to my slides, and my slides express no emotions, no confusion, no appreciation whatsoever. So I have no idea whether what I'm saying to you is confusing you, enlightening you, or raising questions. So far better for me if you ask a lot of questions and I just go through the presentation in a kind of rote way. So don't hesitate to do that. So I'll go back to this a little bit before we end, but just to give you a little better idea of where I'm coming from. I worked on Capitol Hill for a number of years in the 1970s and got involved in drafting some of the legislation on ESOPs and decided that this was really a good idea, something I really wanted to spend my life on, and so started this nonprofit, the National Center for Employee Ownership. We are not a consulting organization. We can do some very preliminary conversation consulting, but we don't set up plans. We're not lawyers. We're not appraisers and the like. Our role in life is to provide objective, reliable, accurate, and comprehensive information on all forms of broad-based employee ownership plans. And ESOPs are by far the most common and powerful of those kinds of plans. So our website, you'll see we have lots of publications. We have a big annual conference that's coming up in April in Atlanta. In mid-April, we expect about 1,750 people at that conference. We are a membership organization, and you can go to our website to find out more about all of that. And there'll be a slide with some links at the end. So what are we going to cover today? So obviously, we're going to talk about what an ESOP is and is not, how an ESOP can be used particularly for business continuity. There are other uses of ESOPs. Some companies just set them up, just is not the right word. Some companies set them up as a means of providing a reward for employees. The owners have no intention of selling right now, but they just like the idea of sharing ownership with the people who help create value in the company. Because there are a lot of tax benefits to ESOPs, that's a very efficient way to do that compared to other ways to provide equity to employees, such as stock options or restricted stock. But we're going to focus here on what accounts for probably 75 to 80% of all ESOPs in closely held companies, and that's their use for business continuity. And they're so popular for that for a variety of tax planning and personal reasons that we'll cover. Now, I said that there are lots of tax benefits compared to things like restricted stock and stock options. But of course, if you're going to get tax benefits, for most things anyway, you have to comply by some rules about, gee, if we're going to spend taxpayer dollars to make it better and more appealing to share ownership, we don't want you sharing ownership with just anybody you want. We want to make sure that that ownership is reasonably equitably distributed. And so we'll talk about how those rules work. Because these are private companies, you obviously need to figure out what the shares are worth. And again, particularly because this is a tax-favored program, we don't want you just picking any number you like. We want a number that's valid. And we're going to talk about whether an ESOP is right for you or for your clients. So let's look at the ESOP landscape. There are about 7,000 ESOPs as of 2016, the last year for which we have comprehensive data. And there are about 14 million participants with 1.2 trillion, not trillion billion, sorry, $1.2 trillion in assets. So sometimes people refer to, you see news stories saying ESOPs are kind of this obscure corner of the economy. $1.2 trillion isn't obscure, and 14 million participants is a big chunk of the labor force in the private sector. So it is a very significant part of the economy, albeit somewhat, I guess, of a stealth part. You see ESOPs commonly used for succession planning, which is what we'll talk about, financing growth, employee rewards, as I mentioned. In public companies, they're often used to match 401k deferrals. And Congress has been very generous in providing tax benefits to selling shareholders, companies, and employees. So there are a lot of myths about ESOPs that prevent more companies from using them. Number one, and we hear this a lot, is, oh, they're too complicated and they're costly. Well, they are complicated and they are costly. The question is not whether they're complicated and costly so much as compared to what if you're looking at business succession. Selling your business to another company or a private equity group or individual investor or even to managers is complicated by its nature. It involves a lot of legal documents. It involves often contingency financing. It involves agreements and contracts between buyers and sellers, long negotiations in many cases. You need to have a lot of accounting work done. You really should have an independent appraiser
Corey?
come in. So you, yes.
We received a question. Can I interrupt you?
Yeah, for sure.
Okay. Can you address the challenges of getting ESOP approval from a diverse set of shareholders?
I will do that.
Okay.
And let me come back to that question when we look at the mechanisms for ESOPs. I think will be better, because for some of you, if I answer that question now, you won't understand the answer because you don't understand the basics. So let me come back to that, but thank you for the question. So in any event, ESOPs really aren't more complicated than selling to other parties, and in most cases actually less complicated. And they're actually less expensive in most cases because many deals are brokered, and brokers get a percentage of the transaction. Now they charge the buyer, but the buyer reduces the price implicitly. So there's a pretty substantial cost to doing that. Even if you don't use a broker, there are a lot of legal and financial costs that are involved. With an ESOP, you don't have brokerage fees. The broker couldn't charge a fee. A broker wouldn't be involved in an ESOP because they're not finding a buyer. There's a myth that employees must end up controlling the company. We'll talk about that later. That's not true. That they're only for C corporations, C or S corporations qualify, as now do LLCs who choose to be taxed as an S corporation. They only work for certain kinds of companies, people say. Big, small, industrial, service, whatever. Different people have different views on that. But ESOPs are dispersed pretty widely through all industries. And ESOPs usually don't work. My brother-in-law worked for one, they say, and it didn't do very well. Well, there are ESOPs that fail, but the default rate on ESOP loans is under 0.5% overall. That's 2.2% per year. Well under, for instance, private equity company leverage buyouts. So why an ESOP? So I'm an owner and I'm thinking about selling my company. And most often it's a single owner or maybe two partners. But you may have multiple shareholders in a private company. And you do have situations, as the question asked, where some want to sell and some don't want to sell. And so you have to, if Joe and Mary want to sell, but Bill is just adamantly opposed to this, Joe and Mary can use the ESOP to sell their shares unless Bill has controlling interest. He can't block it. If he does, then there's not much you can do unless you can convince him, as we'll go through in the rest of these slides, that it's really a good idea for him. But if he doesn't have controlling interest and the ESOP buys, let's say, 2/3 of the company, he's left with 1/3 of the company that's now valued on a minority basis, that is totally illiquid, and the company has no obligation other than whatever contractual agreements might have been made to buy Joe out. So he could sell to the ESOP at some point, and he could get a lot of tax benefits, or he could try to force that contractual agreement and have the company buy him out, in which case his tax treatment would be far less favorable than selling to an ESOP. So as we go through this, I think you'll see that those situations are very uncommon. But if you do have multiple shareholders, there are other issues that you're going to need to deal with, and we can talk about those. So why an ESOP rather than selling to another company? Well, for one thing, the way ESOPs work is that it's effectively a redemption of shares. And when a company buys back its own shares, it buys them in after-tax dollars. So if you have a $2 million company, you might have to generate $3 million or more in sales, and profits, pay tax on those profits, and then you'll have the $2 million left. But with an ESOP, you use pre-tax dollars, so you only need $2 million. So right off the bat, ESOPs are vastly cheaper than any other kind of redemption. Secondly, unlike sales to other buyers who typically want to buy control, you rarely find anybody who wants to buy a minority interest in a closely held company. ESOPs can buy some or all of the stock. They can buy it from one owner only or multiple owners. They're very flexible in that. They can buy some now, some later, or they can just stay at a minority interest as long as you want. Properly structured and run ESOPs can improve competitiveness. We can talk a little more about that later. But overall, the data show that ESOP companies grow about 2.5% per year faster than you would have expected if they didn't have an ESOP. Employees make better wages and have 2.5 times their retirement assets as in non-ESOP companies. And ESOP companies lay people off at 1/3 to 1/5 the rate of other companies. So pretty much no matter how you slice it, ESOPs as an economic entity have been a very powerful engine. S corporation ESOPs, which now most of them are, you may not start that way, but they become an S corporation, because the percentage of profits attributable to the ESOP in an S corporation are not taxable. So if you make $2 million in profit and you're 50% owned by an ESOP, 50% of your profits aren't taxable. If you're 100% ESOP, which now probably close to half of all ESOPs are, you don't pay any taxes at all, federal or in almost every state as well. That's a nice advantage. We'll go through each of these in more detail, but ESOPs are a defined contribution plan under the Employee Retirement Income Security Act, the same law that governs 401k plans, profit sharing, and pension plans. And if you're familiar with ERISA rules, a lot of the ESOP rules are the same. They are company sponsored and paid. So this is a really important point. Often when I explain how ESOPs work to people, I go through the whole thing and people say, I got everything you said, Corey, but when do the employees buy the stock? They don't buy the stock except in very rare cases. They are paid for out of corporate contributions of tax-deductible profits. So they are, I just want to emphasize that one more time. Employees don't buy the stock, company buys it for them. All full-time employees usually have to be covered, and they are subject to service investing rules. And employees get accounts in the ESOP. They hold on to those accounts during their tenure there, and then they get a distribution on flexible terms after they leave. So I always like that old cartoon. So how does this actually work? The basics, which we'll go through in more detail. The company sets up an employee benefit trust called an ESOP trust. It then contributes cash to the trust, which the trust can then use to buy shares. Or it can have the trust borrow money, and you see that happen when you want to buy a big chunk of shares all at once. So the trust takes out a loan. Often it is a lender loaning to the company and the company reloaning to the ESOP. Lenders don't like to loan directly to the trust. And the ESOP takes that borrowed money and it buys the owner's shares. And then the company repays the loan by making tax-deductible contributions to the trust each year to repay the loan. And as that loan is repaid, the shares in the trust get allocated to employees. Again, the employees don't buy the stock. And contributions are tax-deductible, generally up to 25% of the eligible pay, that is the pay that's covered in the ESOP, not your total payroll, but the payroll of people in the ESOP, not counting pay over $275,000 a year.
Corey, we've received some
Yes.
questions.
All right, good.
Okay, first question is, would you explain why company buys stocks as opposed to employees?
Because the employees don't have the money. Most companies are worth 6 figures per employee, and there just ain't no way that employees are going to buy the company. So that's one thing. The second thing is that it's not only impractical, but it's too risky for employees, even if they did have the money. So if ESOPs worked that way, you'd have, we wouldn't be having this conversation because there'd be 100 of them, not 7,000 of them. You see management buyouts from time to time, and typically those require significant concessions on prices and financing terms provided by the seller. So it's just not very practical to do it that way.
Okay, thank you. The next question we have is, has this ERISA done anything yet in high quality services?
I'm not sure I understand the question. Lots of service companies have ESOPs, if that's what the question is. Engineering companies, architecture firms, various other professional firms. ESOPs are very common in engineering companies, for instance. Maybe the question, that's not the question. But again, ESOPs are not industry specific.
Okay, thank you. Okay, that looks like that's all we have for right now.
Okay, so a big question and a threshold question that the seller has is, how much am I going to get if I sell to the ESOP? Could I get a lot more selling to somebody else? And the answer is that the price must not be higher than the fair market value on a financial basis is determined by an independent outside appraisal firm. So this is not a synergistic price that, for instance, a competitor might pay. It's what an investor would pay. And the investor basically is making that decision based on an estimated earnings that you're going to make for the next typically 5 years, and then using a discount rate to discount each of those out years' earnings into a total present value. So if I'm a company, I make $2 million a year, we're going to end up with a multiple of earnings when we sell. And right now, those multiples are running typically between about 4 and 7. For the vast majority of companies, the sale price to an ESOP is competitive with the sale price to other potential buyers. But for a small minority, there is a synergistic buyer offering a substantial premium. Now, that premium will be, of course, taxed. Company seller will pay capital gains on the tax. Whereas, as we'll see with an ESOP, the seller can defer tax on capital gains, so that even with a premium, often ESOPs still end up in a better place. If you have minority ownership, those shares are valued less per share than control shares. So, as I said, the most important element of valuation is a multiple of free cash flow, typically earnings before interest, taxes, depreciation, and amortization, or EBITDA, typically over 5 years. Discount rates on those earnings are typically 13 to 18%, which translates into those 4 to 7 multiples that I talked about. But they'll also look at comparable company sale data, public company comparison data on earnings, and asset value, and they'll throw these all into their magical black box and come out with a number. If you've got 5 different valuations, they'd probably end up all within about 10% of one another if you had qualified appraisers. So sellers looking at this and say, okay, I can live with that price. Tell me more. Well, number one, if the ESOP is a C corporation or converts to a C corporation, and the owner owns more than 30%, then the ESOP ends up with 30% or more of the company, the seller can defer tax on the gain by reinvesting in qualifying stocks and bonds, which we'll talk about a bit later, but there's lots of securities you can invest in. If you don't want to do this, it still qualifies as a capital gain. But that tax deferral is a big deal, obviously. It can save you an awful lot of money over time. If you're an S corporation, it's not available unless you convert to C, but there are other tax benefits for S corporations. I mentioned the one that's the most powerful, which is that you can, the taxes attributable to the trust are zero. The ESOP can buy some stock now and some later. This is a pretty big deal, especially now. A lot of baby boomers really don't want to just quit and leave. They want to get out gradually. And often they want to stay involved at some level. Maybe on the board, maybe they'll even stay on as CEO for a while. Maybe they're, as in one company whose board I'm on, the owner is now almost completely sold out, but he stepped down as CEO so he can focus on doing what he loves, being an engineer, and somebody else is the CEO. So it gives you a lot of flexibility, and for a lot of us baby boomers, that's really important. So some of the rules for the tax deferral: you have to have held the shares for at least 3 years, only C corporations. That 30% rule, that there's a bullet there explaining more detail about that. And if you have family members or other 25% shareholders, they can't get any of that stock back in their accounts in the ESOP. You can see here some of the eligible investments. There's quite a few stocks and bonds that you can invest in, so this is not a big deal.
Corey, we have some more questions.
Okay.
How common is it for a valuation to be challenged after the ESOP closes?
Extremely uncommon. That the employees could sue saying it was improper, or the Department of Labor could. Typically, in the Department of Labor, I would say between lawsuits and investigations on ESOPs, maybe 15 to 20 times a year out of 7,000 plans. So not common at all.
Okay. Can you talk about how a board must be constituted to be seen by the trustee as a change of control?
That's not an issue in an ESOP. I understand what the questioner's asking about. Yet, often you have to have change of control rules for capital gain treatment of sales of companies. ESOP laws, ERISA trumps that law. You can have whatever board you want in an ESOP. Increasingly, we're seeing ESOP boards include outside independent directors. That 74% of companies do that. That's totally voluntary. So there's no issue with that in ESOPs, just not an issue.
Okay, thank you. And the last one we have is, does the tax reform of 2017 have any impact on ESOPs?
There may be some indirect impact on ESOPs. It may, for reasons that are probably too complex to worry about here, it may increase the valuations of privately held companies, including ESOPs. So there could be that. That's probably the most important effect. But we were very fortunate, that Congress is looking for all sorts of things to cut back on so they could help pay a little bit at least for this tax reform. But ESOPs have very strong support, and they weren't touched at all. So that worked out well.
Okay, thank you.
Okay, so again, the big deal with S corporations is the non-taxability of profits attributable to the trust. So you might often see, for instance, a company become a C to do the sale, or it already is a C, but if it's an S and it becomes a C, they'll do the sale and then 5 years later reconvert to S. They have to wait 5 years to do that. And then if it's 100% ESOP, as is often the case, you're in tax heaven because you don't pay any taxes. So how do you fund this thing? Well, banks can loan money to ESOPs. Banks like ESOPs because their default rate is so vanishingly low. So ESOPs are very good borrowers. But if you don't want to get a bank involved for all or part of the transaction, you can have a seller finance note. So these notes are negotiated. The ESOP trustee, that's the individual or organization that is responsible for looking out for the interests of the participants in the plan, will have to make sure that the terms of that note are reasonable and fair to the ESOP. We're typically seeing interest rates on those notes around 5 to 9%. Sometimes there are more complex structures like lower interest rate and warrants. But the seller financing has become very common in ESOPs. The sellers are confident they'll get their money back, and they just may not want to bother with the bank. So those two ways will finance the leverage, or the company can just put cash into the plan each year to buy shares, or some companies plan in advance by putting cash in for 2 or 3 years, and then they make a big purchase all at once. And in very limited circumstances, some employee money from existing plans will be used. That's complicated, it's expensive, and it only should be used rarely. So with seller financing, again, the seller takes a note for the shares. That bullet actually has a typo. Just say the seller takes a note for shares. I'm not sure how that, with multiple employees, got involved there. Employees Oh, this is where you're selling it directly to employees. I'm sorry. So this is an alternative to ESOPs. And here the seller financing would be to make it available to individual employees to buy stock. You can see that the way that this works is not as tax advantaged. With leveraged ESOPs, the plan can borrow money to buy existing shares, or you may want to just you want to issue new shares and have the ESOP borrow money. It buys those shares. The other owners suffer a dilution, but the company, because of the terms of ESOP, is financing growth with pre-tax dollars. As I said, the company can just contribute cash. And when you do borrow money, what happens is a suspense account is set up. So it's sort of like a bank within the ESOP. And each year, as say 10% of the loan is repaid, 10% of the shares get released to employee accounts. So let's review the flow here. And you can just read that slide. I'll give you a minute to do that. So some key points to remember. The second one is a real critical issue because this ESOP is funded out of future corporate profits. It is a non-productive expense. If you don't have enough profits to do it, this won't work. Now, there are limits to how much you can put into the ESOP. They're on this slide here. I don't think we need to spend much time on this because I haven't in the last several years encountered a company where the limits are a problem. More important are the rules about participation, vesting, and allocation. So who's in the plan and when do they get their money? So like all ERISA plans, employees have individual accounts. In fact, these kinds of plans, ESOPs, profit-sharing 401k plans, are generically called individual account plans. So now the company has contributed stock or it's had the ESOP borrow money and there's shares in the ESOP. So those shares get allocated to at least all full-time employees with 1,000 hours or more of service in a year. You can be more generous. You could include part-timers if you want, but generally you have to include all full-time employees with more than 1,000 hours. There are a few exceptions, most notably union participation is subject to collective bargaining. It's not automatic if you don't want it to be. If you have a separate line of business, it is possible to have an ESOP in one line of business and not the other, but there are certain rules that you have to comply with to see if you meet the tests. Now, once shares are allocated to me, so I've got shares in my account, and each year I will get more shares allocated to me as shares are released from the suspense account or further contributions to the ESOP are made, or in mature ESOPs as shares leave the ESOP. Joe leaves, he retires, company buys the shares and typically will put those back into the ESOP for all the employees. So the shares are getting recycled. So shares are coming in, contributions coming in every year, but those contributions can be subject to vesting up to 6 years. So it could be a 2-year cliff vest, or it could be graduated 20% a year vesting starting after year 2. The allocations have to be based on relative pay or a more level formula. So if I make 2% of the pay, the eligible pay, I get 2% of the shares. If there are some companies that will have formulas that push it down a little more towards lower paid employees, but probably 75–80% of the companies use relative pay for their allocation formula. You cannot base it on discretion, such as merit or who you like or they're your sister.
We've received some more questions.
Okay.
Okay. What percent of financing for ESOPs are via private equity firms?
Very, very little. Some of the big deals involve mezzanine debt from private equity firms, but private equity firms, for a variety of their own reasons, haven't been very interested in ESOPs. There are a few specialized private equity firms like Mosaic, Longpoint, and American Working Capital in the ESOP space, but otherwise they'd rather own it all themselves.
Thank you. The next question is thoughts on B corporations and ESOPs.
A number of ESOP companies are B corporations. B corporations are benefit corporations. Provides them in some states that have these laws with the ability to make it easier to, for instance, consider things other than maximizing shareholder value at the board level. I think from a legal standpoint for ESOPs, it doesn't make much difference at all. Arguably, it makes no difference. It's more a marketing and optics thing about who you want to be, who you think of yourself as. You think of yourself as a highly socially responsible company. Getting certified as a benefit corporation can be something that tells the world that those are values that you cherish.
Thank you. And the next question we have is, do lenders tend to increase the amounts they will fund into an ESOP in lockstep with the improved free cash flow due to tax benefits?
It's certainly part of the calculation. Sure, if you're a lender and you're loaning to an ESOP that's going to be 100% employee-owned and pays no taxes, that's going to give you more cash coverage than you would have otherwise.
Thank you. That's all we have for right now.
So I'm in the plan. I got an allocation. I got vesting. I've been here 6 years. I'm fully vested. I love working here. I don't plan to leave, but 20 years later, I do leave, and I'm ready to get my money. And so give me my money. Well, the company has some flexibility here because it may want not to encourage people to leave to get their money. So the law allows you to say, well, if I'm under retirement age and I haven't died or become disabled, then the company can wait up to, it's effectively 6 years to start paying me off, and then it can pay me in installments, equal interest installments. If it's death, retirement, and disability, it's 1 year after I leave when that has to start. And it can pay me in two ways. It can say, well, you're going to get 1/5 of your stock or whatever percentage we decide to pay you in that distribution, and then you'll get whatever that's worth at the time we make the distribution. Or very commonly, the company will, even when you leave, translate your stock into cash. And I mean, do that literally because it's going to buy your shares within the plan and put cash in the plan. Then that cash will be invested and you'll be paid out later. Or if you continue to hold shares until your distribution, rather than the company saying you'll get your shares over 5 years, we'll give you the value, say it's $150,000. We're going to say you've got $150,000. We're going to pay that out at $30,000 a year plus interest for 5 years, and you actually get the money. So you have a choice as a company. I'd say most companies favor the cash option. And with S corporations, because you don't want anybody holding shares outside the plan, it's always the cash option. There's also a diversification option if you've been in the plan for 10 years and you're over 55. Has to be at fair market value. The employees have a put right for the shares, and the distributions are taxed in the same favorable way as, for instance, 401k distributions. Excuse me. Very limited employee voting rights are required, but you can extend them if you want. Voting just almost never comes up. The plans are governed by a trustee appointed by the board. It can be an outside institutional trustee, or it can be insiders. We don't have time to go through this, but these trustees are subject to strict rules under their Employee Retirement Income Security Act. The most important of these is to make sure that the valuation is done properly and represents truly fair market value. There's often a designated ESOP committee made up of a few people in the company that acts as sort of a plan oversight committee, liaises with the board, management, and the trustee. Cost, typically $80,000 and up. It could be quite a bit up. Ongoing cost could be as low as $15,000. A company of 100 or so typically is going to be looking at $25,000 to $30,000 a year. A lot of that's for the annual valuation. So as I mentioned before, ESOPs are more expensive than other plans, retirement plans, but much less expensive than other ways to sell. So I know I've gone through a lot of information here, and it's even so still probably fairly skeletal about how all this works. But we have lots more information. I really encourage you to call me with questions. That's my phone number and my email. I'd be delighted to follow up with any of you individually. That's what we do. Our organization's website is nceo.org. These are live links, at least I hope they are. You can paste them into your browser if you like. If you go to nceo.org, you'll see lots of articles on how ESOPs work, lots of basic articles. But then we also have a lot of other material that I think you'll find very useful on how these plans work. If you want to delve into this in more detail, we have a book. We have lots of books, but the one specifically on this is Selling Your Business to an ESOP. If you join, it's only $90 to join. You can call us anytime with questions. We have a document library with forms, templates, checklists, and other things to make life easier as you do this. We have weekly webinars. They are free to members. They're at 12:30 Eastern Time every Tuesday. We have lots of other resources, including over 700 questions and answers that you can search as part of the member benefits. So with that, I hope there are some remaining questions. We've got 3 minutes left, or as long as you want.
Well, thank you so much for this informative presentation, Corey, and we do have some more questions. Okay, so would you touch upon legal requirements with regard to minority shares, especially where valuation is concerned, such as minority shareholders disagree with valuation?
Well, let's say that you had 3 owners and the valuation is $100 a share. That would assume, well, you're going to have what's called an enterprise value. That's the value of the entire company. Now you have to divide that by shares. If you have a 60% owner, if you have a $2 million in value, the 60% owner has more than $1.2 million in value because the 60% owner has control. So if the majority owner is selling to the ESOP, the majority owner could get a control price. The minority owner now is left with shares that are only worth a minority price. So they might be upset and say, well, you should have sold the whole company. So can you challenge the valuation? I suppose you could. I frankly never seen that happen because you're not likely to win, number one. And number two, more realistically, that minority owner is going to say it would be a lot better for me just to go along with the transaction. I was in a situation once where we had this, where the minority owner just refused to sell and he was going to sue. And we had a meeting with him and the board and the other owners, and I said, you can do all of this. It's highly risky. And if you lose, you're really stuck because there's no obligation to buy your shares, and they now are going to be worth even less than they were before. So there may be a more complex situation here, and I encourage the person asking this, just give me a call or send me an email and we can maybe get into the weeds a little more on this, because it's not a typical scenario.
Thank you. So we are getting close on time, and we do have a lot of questions. I'd like to keep going if that's okay with you.
I'm happy to go as long as you want.
Okay. And for participants, if you're unable to stay on, the link to the recording will be sent to you, so you will be able to get this information. But thank you, Corey. So the next question that we have is, what valuations do you typically see for full buyout ESOP plans?
How to answer that question, I don't know what that means. What valuations do you see? It depends on the company. So maybe the questioner could clarify that.
Okay. Will regulators allow the allocations to be made based on tenure or just salary?
You can have a tenure aspect to your formula. Here's the catch. Whatever alternative formula you use to relative pay has to produce a result that doesn't end up with what are defined as highly compensated employees. So that's people making, I think it's now $115,000 a year or more. It's either 115 or 120. I can't remember the current number. So if any of those people get more than what they would have gotten from that formula based on a relative pay formula, then that excess has to be reallocated to everybody else. So if I make $150,000 and under a straight pay formula I get 5%, but under the tenure-based formula I get 7%, then 2% has to be, before it's ever allocated to me, has to be reshuffled to everybody else. And then you have to test again to make sure that that didn't result in somebody who was making 135 getting too much. So you have that kind of fail-safe written into your provision. I do see, I'd say the second most common allocation formula I see, maybe 10 or 15% of the company, is a point system that has, maybe a point for salary and a point for tenure. Again, with this fail-safe that you, if you're highly compensated, can't get more than what straight salary would indicate.
Thank you. Would you point out any missteps that occur when implementing an ESOP?
That's an important question. First of all, before you even get into all of this, you should have some sense of what your company might be worth. You may want to have a preliminary appraisal done. You probably don't want to hire that same person to do the full-blown appraisal for legal reasons that we don't have time to go into. But you may want to do that. Frankly, most of the owners I talk to, they want to get a fair price, but their biggest concerns deal more with legacy and their own personal plans. So they figure, well, if I get a fair valuation, then that's what it is what it is. And I might have different ideas, but I'm probably wrong, and I'll live with it. But before you go into this, you need to really ask yourself, do I really think I could get a lot more money realistically from another buyer, and is that going to matter that much to me if I do? Second thing you have to think about is leadership. So if you are the rainmaker in the company, and if you leave, the company is in big trouble, an ESOP's not going to work for you. You need to make sure that successor leadership is in place. Third thing is, as I said, this isn't for the faint of wallet in terms of your profits. If you're marginally profitable, or you're profitable one year and you lose money the next year, can you really afford to do an ESOP? Maybe you need to cut back on how much the ESOP can buy, or do it more gradually over time to give yourself more flexibility. And the last thing is, what's your culture like? ESOPs perform best in companies with high involvement open book management systems. If you tell people you're now owners and you treat them like wage slaves, you're not going to get the bang for the ESOP you expect, and you may be angry and disappointed about that. So if you have a culture, though, that really does value and seek employee input and that shares a lot of information, an ESOP is going to be a really good fit for you.
Thank you. And our last question is, how do venture capital firms view ESOPs in startups?
Two problems with that. Number one is ESOPs are almost never used in startups. Because it's expensive, you don't have profits typically, so the tax benefits aren't any good to you. So I see ESOPs in startups a few times a year. They're typically well-funded startups where it's realistic to do this. Startups use stock options, restricted stock, and the like. Venture firms like having in the early stages most or all employees having some form of equity, but you typically do that through individual equity plans. We have a lot of information about that. We have a book called The Decision Maker's Guide to Equity Compensation that looks at all the different approaches to equity compensation for entrepreneurial companies. But ESOPs are not really a good startup tool.
Okay, thank you. And that was it for our questions.
Well, thank you all very much. And again, contact me. I love to get questions. So let me know and take a look at our website and you'll find some more information. I really do appreciate everyone's sticking around, and I especially appreciate the folks at Rutgers and the New York Employee Ownership Center, which we're delighted to have helped get off the ground in the last year, doing great work. And I want to thank you all again and have a great day.
Thank you, Corey, for this presentation. Thank you, everyone, for participating. So this concludes our webinar. Please feel free to reach out to Corey if you have any questions, or myself. You have my contact information. Also, the website for the New Jersey, New York Center for Employee Ownership, if you'd like to check it out, is ownership.rutgers.edu. We are affiliated with the National Center for Employee Ownership. Thank you all for your time today.
Thanks.
Bye.